Anything above 50 represents growth, and anything below that, a contraction, came in at 52.5. That was up from 52.1 in December, and it was the best reading since May last year. S&P Global, which compiles the figures, said the upturn had been led by a further rebound across the services sector and a modest degree of employment growth in the private sector. The flash figures are based on 85% of survey responses. We'll have more on this later on in the programme. Royal Mail could be allowed to deliver letters just 3 days a week under a series of options that have been outlined today by Ofcom. The industry regulator said its consultation document was designed to spark a national debate on the future of the UK's postal service and help it run a sustainable service. Ofcom's chief executive, Dame Melanie Dawes, told Sky News that a sharp decline in letter volumes and rising costs meant there was a clear need for change.
So we need to reflect now on what we need from that service, because it just gets more expensive if Royal Mail are passing our homes every single day, but with fewer and fewer letters. There's a risk that we either have to pay a lot more or that the service actually becomes unsustainable. But we need to, I think as a country then what we need from this service, because you know, we can't have everything. We're increasingly sending things by email or by text or by WhatsApp messages. So we need that service to be there when we need it. But if we want it to be sustainable and affordable, I think we're going to have to accept some change. We don't think that doing nothing is an option here.
Well, our business correspondent Adele Robinson is with me. Adele, I noticed that Royal Mail's parent company share price is up 5% on this news. I mean, it will clearly make the Royal Mail a far more sustainable business in future if this is allowed to go ahead.
Yeah, and I think that's important to mention and to remind people that, remember, Royal Mail is a business. And according to Ofcom and Royal Mail, of course, this is about sustaining that business in the longer term with a affordable solution. Now, what we know is that these options on the table have already drawn criticism. They may not happen, but the general consensus is that something does need to change. As the chief executive alluded to there, Royal Mail is sending fewer letters now, 7 billion a year still, which sounds a lot, but it's actually set up to deliver 20 billion. And since 2011, the number of letters being delivered has more than halved. It also lost as a business £319 million in the first 6 months of last year, and it was fined £5.6 million by Ofcom for poor performance. And so this is something that has been needing to be looked at for a long time. Cutting back on deliveries, some not happy with those options so far. The Federation for Small Business say that actually scaling back is not the way forward for small businesses and that it could compromise trust in the Royal Mail. Also, the Communication Workers Union not happy. They say that their frontline workers haven't been consulted on this, and they say if they're not spoken to about it in the coming months, then they themselves will deliver their own report on what they believe the future of Royal Mail should look like. And also Citizens' Advice. They say that this should not be about Royal Mail's bottom line. It should be about prioritising customers, and that cutting down on letter deliveries won't necessarily make the service more reliable. But they say, again, this is about sustainability and affordability, according to Royal Mail and Ofcom. The options do involve making legal changes, though, because, of course, the Universal Service Obligation, or the USO, is something that requires Royal Mail to deliver across the country for a fixed price for 6 days of the week. The Ofcom report that's been released today, they are saying that if it goes down to, say, 5 days a week, it could save up to 200 million. If it goes down to 3 days or alternate days, that could save up to 600 million. So again, consensus that the service does need to modernise. It's not sending as many letters as before. The consultation finishes in April, and we should find out a little bit later on this year what the future holds for Royal Mail. OK, thanks, Adele. Now, there was a good deal of concern last year over the health of London's capital markets. Yet a report published today claims London is the world's top global financial centre, ahead of New York City, Singapore, Frankfurt, Paris, Hong Kong and Tokyo. The fourth edition of the City of London Corporation's International Competitiveness Study said London beat New York in fields such as international bond issuance, sustainable finance and cross-border banking. Well, joining me now is Chris Hayward, Policy Chairman at the City of London Corporation. Chris, welcome to you. I mean, we should stress that this is your own research, that other rankings, notably the Global Financial Centres Index, which is widely followed, still has New York on top.
Yes, I mean, this is an independent survey, nevertheless. We commission it, but it is independently run, independently verified. It looks at 101 different metrics, and we've been at the top for the past 4 years, but last year we were actually equal with New York, so we've pulled ahead again this year. So I think it's a huge vote of confidence in the City of London.
And yet all metrics are not equal, Chris, and if you look at some of the key ones, assets under management, capital markets activity, those both dropped off last year.
Yeah, look, there are other things we still need to do, and capital markets is probably the biggest challenge. We've talked before about the importance of trying to build a fund fed by the Mansion House Compact, which was about DC pensions, 5% of DC pensions being injected into a fund. We know that listings are down all over the world, but it's been particularly hard, IPOs have been particularly hard hit here in the City of London. So we need to find additional capital to inject into our fast-growing British businesses to ensure that they stay here and scale here.
Are you optimistic that the attractiveness of the UK's equity markets in particular is now being addressed?
Yes, I am. I think we've come in the right direction in that respect now. I think there's a huge amount happening in the city, which is really cause for comfort, I think. Ease of doing business in the city, our regulation, our financial regulation. You touched on our leadership in green finance. I'd also touch on skills and talent. The fact is people want to come and work in London, want to work in the city, and we've got growth in our office market as well. So actually, I think to some extent, in a post-EU market, we now need to have global competitiveness, and this is what this survey demonstrates.
I mean, you mentioned skills there, Chris. One of the things in this report that jumped out at me is that London is identified as having noticeably poor levels of training.
Yeah, training is a challenge. We need to invest in training much more. We also need to make it more cost-effective in terms of business visas to actually work in this country. We lag there in relation to the US. And technology is now another growth market for us. In fact, technology grew faster in the square mile this past year than even financial services did. We're still a long way to go to compete with the US on that, but I think we're making grounds there too.
What about quality of life? I mean, no one pretends that Singapore or Frankfurt are more fun than London or that New York is cheaper, but yet it does feel as though living in London is increasingly out of bounds for young people in particular.
Well, I'm afraid the cost of housing, affordable housing in London for young people is a real challenge, and that's something we want to see addressed. It's really important. But when you look at the vibrancy now of the City of London, our nighttime economy, our retail offering, our destination and cultural city offering, we're finding that more and more young people across the globe actually want to work here. The challenge is to make it affordable for them to do so.
Indeed, big challenge. Chris, good to see you as ever.
Thanks,
you.
Ian.
Some other business news stories for you now. And the software giant SAP said today it is to cut 8,000 jobs. That's around 7% of its global workforce as it steps up its focus on artificial intelligence. Germany's biggest company by stock market value said it would invest €2 billion this year in backing AI-related startups and retraining staff to use the technology. But it said that as part of the process, this would involve job cuts. It expects most of the reductions to be achieved by voluntary redundancies. Shares of SAP, which this time last year announced 3,000 job cuts, are ahead 7% in Frankfurt this morning. EasyJet said this morning it had taken a £40 million hit from the Hamas-Israel conflict during the last 3 months of last year, as it was forced to pause flying to Israel and Jordan, and bookings to Egypt fell. Despite this, the carrier was able to reduce pre-tax losses during the period to £126 million from £133 million in the same months in 2022. Johan Lundgren, the chief executive, said EasyJet was seeing positive booking momentum for this summer, with flight and holiday bookings taking off strongly during the turn of the year, with Spain, Portugal, Greece and Turkey all selling well. The shares are 5% ahead just now. The pub operator JD Wetherspoon said today it had enjoyed a bumper Christmas. Sales during the 25 weeks to last Sunday were up 10.1% on the same period a year earlier on a like-for-like basis. That's the measure, of course, that strips out the impact of new openings and refurbishments. But that accelerated to 15.2% in December. However, Tim Martin, the founder and chairman, warned that while inflation was in general reducing, labour and energy costs were far higher than they had been prior to the pandemic. The shares are off 0.5%. The wealth and asset manager Aberdeen said this morning it suffered £12.4 billion worth of net outflows during the second half of last year. The company, which also owns the investment and trading platform Interactive Investor, said market conditions had remained challenging for its mix of businesses, and that as a result, it was taking significant cost actions to restore its core investments business to a more acceptable level of profitability. It confirmed, as first reported by Sky's Mark Kleiman this time yesterday, plans to cut around 500 jobs. The shares are currently off by 3%. And the hedge fund billionaire Bill Ackman and his wife are buying a 4.9% stake in the Tel Aviv Stock Exchange. Mr. Ackman, the founder and chief executive of New York-based Pershing Square Capital Management, has been a vocal supporter of Israel since it was attacked by Hamas terrorists on the 7th of October last year. More recently, Mr. Ackman helped remove Claudia Gay, the former president of Harvard University, amid allegations of plagiarism and complaints that she has been slow to rein in campus anti-Semitism. Now, the Co-op today announced plans for a major expansion of its retailing business. It includes opening 400 new nicer stores, buying sites for new Co-op stores, and more than doubling the size of its franchise business, which currently has 38 stores. The Co-op, which currently operates nearly 2,400 stores and which has a 5.4% share of the UK grocery market, also said it was targeting a major expansion in the number of active member owners it has from the current 5 million to 8 million by 2030. Well, joining me now to talk about this is Kenyata Nelson, Co-op's Chief Membership and Customer Officer. Kenyata, welcome to you. I mean, this is a big expansion of the store estate you're proposing here. Are there parts of the UK where you feel the business is underrepresented?
I think, first of all, thank you for having me on the program, Ian. When you look at the growth plans for the Co-op, they're pretty simple and centrally focused on creating value for our members. Wherever they are, wherever they live, there's three things we're focused on doing. The first is making sure that we attract members with a really strong proposition. The second is serving them in the way they seek to be served and where they are, no matter where they live in the UK. And then thirdly, making sure we do so in as convenient a way as possible and creating value in the process of that, and not just economic value and value for money, but also value in the communities they live in, and as member owners of the Co-op as well. When you look across the UK, we seek to serve our members no matter where they live, and no matter how they seek to engage and interact with the business.
I mean, the likes of Morrison's and Asda are also trying to expand their convenience offerings. I think Asda are opening 21 convenience stores this month alone. Do you worry that this is going to bid up the price of some of the stores that you may seek to acquire?
I don't think so, and that's not particularly the focus of us at the moment. As you may know, we're a member-owned organization, so our concern and our focus is on creating value for our member owners in any way that they see fit for us to do so. So whether that is through convenience in physical stores or in the digital channels and e-commerce and the wholesale businesses that we operate, our focus is on creating value for our member owners and making sure we serve them in the best way possible. Less concerned about what competition is doing in that context. The difference for us is about the fact that we are not owned by shareholders, we're owned by our members. So our focus is on creation of member value for our member owners across the cooperative.
Now, you've also announced a big round of price cuts today. Does one have to be a member to benefit from those fully?
Yeah, so we've done two things, in fact. So today marks the next phase in what is £100 million plus investment in pricing across the cooperative. We've also invested in pricing more generally across our food business as well and across our life services businesses. So although members will save more, the savings across the group have been invested in and will continue to be invested in. Value for money is important for us. We've heard from our members that they are seeking to save more in the way that they engage across retail and across our life services businesses. So we seek to create good value and positive value creation for those members, as well as the customers who shop across our suite of businesses.
Now, obviously, the likes of Tesco and Sainsbury have been moving towards a sort of two-tier pricing model, which benefits the members of their loyalty schemes. Is that ultimately going to be the direction of travel for the Co-op?
Opportunity for distinction to be made here. For us, this is about the creation of value based on what our members are asking us to deliver for them. It's less about getting people to buy things they don't need or shop in areas that are not value additive. We've invested the vast majority of that 100 million I mentioned in things that are critically important for our members on household staples, dairy, milk, cheese, nappies for children, pet food. And so for us, it really, really is about creating value for members in everyday essentials rather than just creating a two-tier price system to get people to buy and shop in the context of things that are not particularly value additive or not essential to their household needs.
OK, Kenyata, got to leave it there. Great to talk to you this morning. Thank you. Still to come here on Business Live, we'll have a look at how the markets have started the day. Don't go away.
I mean, she's a very interesting woman. The more you kind of get to know her, the more you want to know about her, really. She's an absolute pioneer for education, for equality, so for women's equality, and in general, the power of education. You know, the fact that education gives you the opportunity to do anything, anywhere in the world. She really sort of paved the way for that idea of education opening doors. I mean, I think there's different aspects of proving sainted today. So there is partly the miracle element, which sadly we don't know too much about. So there are things kind of ongoing on that front that are necessarily kept confidential, while they're being investigated. So the other element of it is proving, relevance to today's society. So it's not just a woman from Yorkshire 400 years ago. She's a woman who changed things, who is relevant to today, who talks about values that we can identify with, and who people should know about. So it's not just about that well-known bit of it, it's the other side of it as well. The idea that it's something of relevance to today's society and something worth celebrating. The followers of her order are still changing, education. So there's been recent legislation in South Sudan that her sisters have actually influenced her order that's working there currently to provide education for young girls. So for Mary Ward herself, this is at a time where philosophers are debating if women even have souls or not. So women are just seen as, wives and mothers, that's all they're there for. And Mary Ward says that they deserve an education, they're intellectually as capable as boys, they deserve an equal education, they deserve all the opportunities that boys get, and with education, anything is possible for them. It's very modern as an approach.
Fly Emirates, fly better. Fly Emirates, fly better. Thank you.
Welcome back. Let me take you back to the markets now. And the pound is up against the US dollar on the back of those flash PMI figures, up 0.2%. Sterling has also today hit a 20-month high against the euro, again on the back of those better than expected flash PMI figures. The euro, meanwhile, up nearly 0.2% against the dollar itself. On the equity markets, after last night's sell-off on Wall Street, there was mixed trading overnight in the Asia-Pacific region. The standout features were again the Hang Seng in Hong Kong and the markets in Shanghai, both lifted by hopes of intervention by the authorities to support the markets. Well, in Europe, stocks are all trading nicely to the upside this morning right now. I'd draw your attention in particular to the DAX in Germany, which is up by 1.25%. I suspect a lot of that is being driven by SAP, which is up 7%, as I mentioned earlier. That is by far and away the largest company in the DAX. Talking points elsewhere in Europe today include ASML. The Dutch chip-making equipment supplier is up by nearly 6.5% in Amsterdam after its quarterly results beat expectations. Well, here in London, the FTSE 100 is just about in positive territory, up a third of 1% right now. The mining heavyweights are lending support there. Among the percentage gainers, well, anything with a bit of Chinese exposure is doing well this morning. That includes the likes of Burberry, HSBC and Prudential. To the downside, the consumer healthcare group Haleon is off some 2%. That appears to be on adverse broker comment. Outside the FTSE 100, as I mentioned earlier in the programme, Royal Mail's parent company, International Distribution Services, is up some 5%. On the Ofcom statement. Meanwhile, Wizz Air is up some 4% in sympathy with EasyJet on the back of that positive trading update. EasyJet itself up 3.75%. Meanwhile, the fluid storage specialist TI Fluid Systems is ahead 0.5% on a trading update. Of course, part of the old TI group, one for our older viewers there, former FTSE member way back when. The oil price, little change this morning. Barrel of Brent crude currently changing hands at $79.50 a barrel. Well, joining me this morning is Axel Rudolph, Senior Market Analyst at the global financial trading platform IG Group. Axel, good to see you this morning. These PMI numbers for the UK are really quite surprisingly strong.
They are, yes. And we've seen the strongest rate of output growth in the UK since June of last year, and that was driven by services sector activity, which rose the most since May. All of which is pretty positive. Also, if you look at business confidence, that also came in at the highest reading since May of last year. So, yeah, positive start to the year, really.
But there are so many contradictory signs around the UK economy right now. I mean, earlier this week we were talking about the really quite disappointing retail sales figures for December. I mean, it's just hard to reconcile all these conflicting pieces of information.
It's very true. I mean, if you also look at the manufacturing sector, for example, that actually grew the least in the last 3 months, and that was because of higher input costs. You still have these cost pressures in the manufacturing sector in the UK, and basically the cost of those hasn't yet been passed on to the consumer. But we'll have to see whether people will continue to spend. They have done for Wetherspoons, for example. We'll talk about this in a minute. But yes, I mean, the data is just a flash PMI for the time being, so it's not the definite number yet.
Yes, absolutely right. Should mention in passing as well, the Eurozone PMI data was pretty disappointing today. I mean, not only Germany, where we think there's a recession going, but also France.
Yes, I totally agree. I mean, the UK looks much better short-term than the Eurozone does at the moment. And obviously what we want to avoid is France heading the same way as Germany did. As you say, Germany is still probably in a recession. And these numbers weren't encouraging this morning.
No, indeed not. Well, you mentioned some of the individual companies reporting today. I mean, I guess the sort of star performer today is EasyJet.
Certainly, yes. I mean, EasyJet looks pretty good. It's coming out of the pandemic slowly. I mean, debts are still there, and also the company is still losing money, but it's doing so at a lesser pace than was forecast by analysts, which is positive. And also, I believe, year on year, we saw growth of passenger numbers by about 14%, which is really, really positive. And if you then dig into the numbers, you've got the EasyJet holidays also doing very, very well. So compared to the previous quarter, their growth was about twice as high as before, and profits rose by about 30 million in that sector as well.
Yeah, pretty interesting. Now, what about Wetherspoon? You mentioned them a moment ago. You're obviously bursting to talk about them.
Well, yes, I mean, it's kind of funny because Wetherspoon didn't have a dry January, if you look at the numbers, and sales growth year on year, like for like, rose by over 10%, driven by things like their bars, their slot machines, interesting enough, and also their food sector. But even their small bit of hotel room sales, etc., grow. So Wetherspoon seems to have done really well in December of last year as well, beating its competitors with regards to profits.
Yeah, that's a key point, isn't it? I mean, we know hospitality had a good December, but if I look, for example, at the numbers from Marston's yesterday, I mean, Wetherspoon's like-for-like sales growth is appreciably better.
It certainly is, and maybe it's because they've just done the right thing with regards to the punters. They have relatively affordable food and drinks, and people seem to like their pubs and venues, basically.
Yeah. Now, last night we had a down session on Wall Street, but one of the star performers there overnight was Netflix, which, of course, updated the market.
Yes, I mean, Netflix, again, they have more and more people joining the streaming service, so the numbers of new joiners is up. Revenue is up also. It slightly missed expectations, but not to a large degree. And the stock is actually up over 8% overnight in overnight trading so far.
Big jump. I mean, is the priority for this business in future going to be less about growing the subscriber base and more about improving margins here and charging more? I mean, we know they've been pushing through price increases.
Well, they've already, as you said, done that, and not many Netflix subscribers were very happy about this, but the drop off that some analysts expected to happen didn't happen, really. And yes, I mean, I think it's now about margins more than growing its subscribers.
Yeah. Now, going back to the macro picture, we get a big interest rate decision from the ECB tomorrow. I mean, we've already touched on what's going on in the Eurozone. Any chance of a shift tomorrow, do you think?
Well, in the press commentary, we might see maybe a slightly less hawkish tone, but we'll have to see. There obviously, nobody expects a rate cut. We had rate cut expectations around 65%, I believe, for April. But again, there I would be very much surprised if that were to happen, if the Fed isn't going to cut in March, which is the market's still expecting, but the Fed definitely told us it's not going to happen before the second half of this year. So from that point of view, I don't think the ECB will do much, but maybe it will change its language ever so slightly, which the market can then respond to in a positive way.
Yeah, it really does feel like Madame Lagarde's under a bit of pressure there, doesn't it? Axel, got to leave it there. Good to see you today. Thank you.
Thank you.
Well, that's it from me for the time being. I'll be back, of course, with our afternoon edition at 4:30, and we'll have much more on those flash PMI figures that we've been just discussing with Axel. Well, coming up next, it's Jane Secker with Prime Minister's Questions at midday. There's going to be a short break in between, but do stay tuned. Coming up, as I say, just a few moments, it'll be Prime Minister's Questions. See you later on this afternoon. Cheerio.